What am I looking at doing today, ladies and gentlemen? What I'm looking at doing today, I'm looking at finishing 2 topics here in exactly 40 minutes. You know, AFR is quite a very, very simple paper, ladies and gentlemen. It's a paper that should never give any student headaches here, really. This is the simplest ever paper. And I would want us to start with what we call segment reporting. Segment reporting. So, ladies and gentlemen, remember, when we talk of a segment, what are we looking at? A segment is basically a component. Is a component of what here? A business is a component of a business, is part of a business. It doesn't stop there. We must be having, in this case here, the chief decision makers, who in this case here sit in the board, reviewing the performance of this component. So you're saying that always, it can only be called a segment if in this case here, the board of directors, if the board of directors is interested in its performance, If the board of directors is operated, or rather is interested in its individual performance. So for example, at RCM as a college, we have in this case here 2 components. We have in this case here RCM online, and then we have in this case here RCM physical at Stanbank House. RCM physical. Every time my board would want to know, especially this is a new baby here. How are we performing? How many students, for example, registered in this particular RCM physical on our weekly, like last week? How much do we earn in terms of revenues, in terms of profitability? It is. So we're looking at this as different what year components. But now the question is, remember, we have got what we call aggregation of components. And the aggregation, the standard, the segment reporting standard requires all of us, in this case here, to put together all those products stroke services that are similar. If the product stroke services you're selling in this case here are similar, like now here we are selling CPA to 𝐂𝐈 students. We are selling CPA to 𝐂𝐈 students. So should we report this as different segments? Should we report this as different segments, or should we aggregate and put them together? Ladies and gentlemen, we would have done that very easily because we are basically selling the same what year kind of products to the same students here. However, the standard tells us that whenever you have different distribution mechanisms, like now here, we are distributing this knowledge to students who are here, like now yourselves, through an online platform. Here, these guys must come to the college physically. So in this case here, of course, the distribution channels are different. In this case here, we have differentiating features in terms of, for example, pricing, etc. These guys pay a little bit more, the physical guys. All right. So in that case, then we are properly treating this as what here are segments. However, the most important thing, ladies and gentlemen, that you're supposed to remember before you declare, hey, I'm going to take this as a segment, we have what we call the 10% rule and the 75% rule. Have you ever heard of the 10% rule and the 75% rule? Is there anybody who has ever heard of that? 10% rule and the 75% rule. Anybody who has ever heard of that in terms of segmental reporting? Very important. 10% rule and the 75% rule. You guys are not talking to me tonight. Yes, thank you very much. 10%, 75%. So, ladies and gentlemen, we are looking at these, and I'll read these at a high level. At a high level, this is IFRS 8, talking about operating what year? Segments. And they're telling us that an operating segment is defined as a component of an entity that engages in business activities from which it may earn revenues and incur expenses. It's basically what we call a profit center, whose operating results are regularly reviewed by the entity's chief operating decision organ to make decisions about resources to be allocated to the segment and assess its performance. Ladies and gentlemen, I would want to take you straight away to something very, very important here. Aggregation already I've been able to explain. I've been able to explain this aggregation, and they even are testing us here whether we are able to understand on this concept of aggregation, and I would want to read this very fast. 𝐂𝐈𝐅𝐀 is a UK-based company. 𝐂𝐈𝐅𝐻 is a UK-based company, that sells computer games and hardware. Sales are made through the 𝐂𝐈𝐅𝐻 website, as well as through high street stores. The products sold online and in the stores are the same. 𝐂𝐈𝐅𝐻 sells new releases for $40 in its stores, but for online, it's a bit cheaper. Internal reports used by the chief operating decision maker show the results of the online business separately from the stores. So basically, they are treating these as independent segments. However, they will be aggregated, put together for disclosure in the financial statements. So required, should the online business and the high street stores be aggregated into a single segment in the operating segment's disclosure? If you treat this as a single segment, if you aggregate them, you are making a mistake. You are making a mistake. And I would want to read the answer here very fast. Test your understanding one. If you guys will be able to permit me, remember you're not making any notes. This is just a discussive class, and then you'll be able to listen to the video later. IFRS 8 says that two or more operating segments may be aggregated into a single segment if they have similar economic characteristics and the segments are similar in the following respects. That we are selling, for example, the same type of products or services. That we are selling, in this case, yet to the same type of customers. That we have the same distribution methods. The standard says that segments with similar economic characteristics would have similar long-term gross margins. The 𝐂𝐈𝐅𝐻 stores and online businesses sell the same type of products, and there are likely to be no major differences in the types of customers. I mean, individual consumers are the same. Maybe children would want these games. Therefore, in this respect, the segments are similar and therefore should be aggregated. However, customers will collect their goods from the stores, but 𝐂𝐈𝐻 will deliver the product sold online. This means that the distribution methods are different. Moreover, there are different sales prices between the stores and the online business, giving rise to significant differences in gross margins. This suggests dissimilarity in terms of economic characteristics. This means that it might be more appropriate to disclose these two segments separately. We disclose them separately. Ladies and gentlemen, that is the end of that explanation. I would want to know before I proceed whether we are together. Are you able to understand this man who is speaking very fast like a radio cassette? He has been able to swallow. I mean, remember, it's a high level, it's a helicopter. So long as you're able to get it like a high level, like from the example that I explained of RCM College, then we are good to go. We are good to go. Thank you so much. And then now you allow me to go to the rules here. To go to the rules. So this is what I'm looking at. I love segmental reporting because it may easily come in your exam. Now, ladies and gentlemen, remember, in this case here, at least 75% of the entity's external revenue, must be included in reportable segments. That all the revenues that you are having in your reportable segments must be at least 75%, of the total sales. Ladies and gentlemen, if you have your segments here, assuming in this case here, for example, we have in this case here segment A, segment B, segment C, and then we have got other, and then of course we have got total. So assuming that this total is 100, other is, for example, 40, and then this is, for example, 30, 15, and 15. So assuming that these are the segments that you are taking in this case here to be reportable, what in this case here you are segmenting your organization using reportable segments. Is there somebody who can give me this total revenue, the total revenue of the reportable segments? If you take this plus this plus this, what are we getting? I'm seeing a figure of 60. Is there somebody who is seeing that 60? Is there somebody who is seeing that 60? Is there somebody who is seeing 60? 60 years. So percentage-wise, then this will be 60 over 100. So this will be 60%. 60%. So according to IFRS 8, this 60% of whatever you're calling reportable is less than, it doesn't cover 3/4 of the entire enterprise. It's less than 75%. Then there is a problem. You can't really go ahead and, in this case here, report this separately. You'll be forced in this case here just to aggregate them because they are not meeting the minimum threshold. They're not meeting the minimum threshold. The minimum threshold, the reportable segments, when you add their total revenues, percentage-wise, they should be at least 75%. At least means 75% and above. 75% and above. 75% and above. Now, ladies and gentlemen, we move forward here. So information, and then we have, of course, the 10% rule. Let's see how this is applied. This question was tested the way it is. In your past papers, if you look at your past papers, apart from the names here, they gave us this exact question. So required here, according to IFRS 8, which segments in this case here must be reported? Which segments in this case here must be reported? So the management of a company have identified operating segments based on geographical location. Information for the segments is provided below. So I can see Europe, Middle East, Asia, North America, etc. So I would want us to copy this table down very fast. For you can take a screenshot. For me, I have to copy this. For me, I have to copy this. And I will write very first. I will write very first because we are finishing this in the next 5 minutes, really. So we have the segments there. So we have the segments there. We have Europe. We have Europe. We have Europe. We have a Middle East. Middle East. We have, in this case here, Asia. Asia. We have North America. We have North America. We have Central America. Central America. We have, in this case here, South America. South America. South America, like that. And then I can see the total revenue. The total revenue. So the total revenue, which really is my concern for now, I can see 260, 260. I can see 78. I can see, in this case here, 150. I can see 330, 330. I can see, in this case here, 85, 85. I can see, in this case here, what year? I can see 97. Now, ladies and gentlemen, I would want to draw your attention to something very important here. But when you talk of total revenue, if it's Europe segment, total revenue is what it is selling externally plus what it is transferring internally. 140 plus 120. That's how they are getting these 260. 260. Listen, remember these segments are normally interrelated. So if we have segment A and then we have segment B, of course, segment A must be selling externally. So if the external sales is 140 and then A transfers goods to be worth 120. So in this case here, this will be called internal. So if the internal is 120, then anytime they want us to get total revenue will be equal to external revenue plus internal revenue. Remember, under the 10% rule, we normally use the total revenue, total revenue. So I would want to know whether you guys have been able to copy the entire table. Have you been able to copy the entire table? I don't need this external revenue for now. I don't need this internal revenue, but of course I need the profits. 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 I need the profit stroke loss. Profit stroke loss. What I can see there, I can see 98. I can see a loss of 26. I can see a loss of, no, not loss, but profit of 47. I can see, in this case here, 121. I can see, ladies and gentlemen, 15. I can see, in this case here, what year? I can see 12 there. All right. So in this case here, the profit is 237 there. And then the revenue is 1,000. The revenue is 1,000. And then, ladies and gentlemen, we have assets here. We have assets there. So assets, what am I able to see? Assets. Assets, I've got 400. I've got 345. 345. I've got, ladies and gentlemen, 995. I've got 995. After that, I've got 3,800. 3,800. After that, I've got 580. After that, I have got 880, which in this case is giving me what we call 10,000. What we call 10,000. So according to IFRS 8, which segment must be reported? Which segments must be reported? Here I will get all the marks without knowing what I'm doing. And really, that is the essence. I should be able to pass this. I should be able to pass this. So ladies and gentlemen, I will start with what we call the 10% test. The 10% test. So I'm writing there up there, the 10% test. The 10% test. So you're writing there the 10% test. 10% test. Remember here, we normally carry out 3 tests. We normally carry out 3 tests. So we start with the 10% of the total sales. So number 1, the first one that we are looking at is 10% of the total sales. 10% test. So in this case here, we have number 1, 10% of total sales. This is the hurdle. The hurdle. So this is the total sales. So 10%, ladies and gentlemen, of 1,000. This gives me what there? It gives me 100. So meaning that any segment whose sales is 100 or more should be reported. Whose sales is 100 or more should be reported. So using that criteria, if you are following, what do you think of Europe? Europe, in this case, is selling 260. So 260 is more than 100. So it means that Europe is a reportable segment on the sales perspective. So it means, ladies and gentlemen, that here I put a what there? I put a yes. I shall be able to put a yes there. Are we together, ladies and gentlemen, really up to there? Are we together up to there? Are we together really? I can't feel you tonight. I can't hear you guys. What do you think of Middle East on total revenue basis? Middle East, is it going to be reported? Middle East? No, it's less than 100. So in this case here, no. 150 is more than 100. So in this case here, this is yes, this is yes, this is no, this is no. You write like that. That's number 1 on the basis of total sales. And then we go to number 2 on the basis of total assets. 10% rule. If you allow me, I'll just delete this and write there on the basis of total assets. So in this case here, number 2, 10% of total. This is our hurdle rate, 10% of total assets. So we have 10% of our total assets, which is 10,000, giving us 1,000, isn't it? So in terms of assets, any segment that is able to post more than, or rather 1,000 or more, 1,000 or more, it's reportable. So using the assets criteria, could you kindly tell me, what do you think of this? Oh, they're not talking to me. 3,400 is more than 1,000. So yes, you simply say yes there. This is, oh yeah, yes, yes. We have yes there. No. This is 345. 345 is no. This is low, less than 1,000. So this is no. 3,800 is yes. 580 is less than 1,000. No, not reportable. And then we have 808, which is less than 1,000, which is what there, which is no, like that. So in terms of assets, can we put a correct there? Can we say we are okay now? In terms of assets, Now we go to the last one. The last one, ladies and gentlemen, is what we call results. The last one is results. The results. So results, that's number 3. Results will always be broken into 2. If you remember what your teacher told you, results will always be broken into 2. We have a profitable segments. So in this case here, 10% of profitable segments. So 10% profitable segments nishigana. Hiyo si jina mzuri ya Kikuyu. Profitable, ini profitable, 98. In this case here, plus, this is profit making, 47, plus 121, plus, in this case here, 12. So then could you kindly give me this 10% of the profitable? I'm not including loss-making. I'm not including loss-making. I'm not including loss-making. So according to Dennis, it's supposed to be 27.8. Is that correct? 27.8. According to Dennis, 27.8. Thank you very much. And then now we have B. B in this case, ladies and gentlemen, B in this case here, we're taking 10% of loss-making. 10% of loss-making segments. 10% of loss-making segments. 10% of loss-making segments. 10% of loss-making segments. We are taking 10%. I can see there are only two here. I can see there are only two here. So we have in this case here 26. This is a loss. You can just put it as a positive. Plus, in this case here, what here? Somebody 15. There are only two. Plus 15. So is there anybody who is able to give me this? 26 plus 15. So times 10%. Times 10%. So they're telling me it is 4.1. What were you taught? Here you compare the two, and then you always pick the higher. You compare the two, and then you pick the higher. You compare the two, and then you pick, in this case here, the higher. So the higher, in this case, is 27 point what here? 27.8. That on the basis, I would want to repeat this very well. On the basis of profitability results, we can only say that a segment is reportable if the profit exceeds this figure or if the loss exceeds this figure. Because now we are working with the higher between the two. Because remember, these are the results. And the results, you give us 10% of the profitable segments, 10% of the loss-making segments. And then now, ladies and gentlemen, you pick the higher of the two. So the higher of the two is 27.8. So now using this 27.8, is there somebody who can give me, in this case here, the reportable profits, reportable segments, I mean. 98 is more than this. So 98, so this is yes. What do you think of this loss of 26? You're comparing it with this. You're saying you would want, in this case here, the loss to be more than. The loss to be more than this. It would have been more than this. For example, if it was a loss of 29, 30, this loss is less. If I took this as a loss now. So in this case here, this is no. How about this? 47 is bigger than this. So this is yes. How about this? So this 121 is more than this. So this is yes. This is less. This is no. And then lastly, we have 12, which in this case is less than this, which gives me no like that. Which gives me no like that. And then now you come and create the last column of conclusion. The last column of conclusion. Whenever there appears any yes anywhere, then automatically that is going to be a reportable segment. So like now, Europe, at least I can see yes, 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 yes. So in this case here, Europe is reportable. How about Middle East? Somebody who is able to follow. Is Middle East going to be a reportable segment? I'm seeing no, no, no throughout. So in this case here, no, no. Somebody who is following. How about Asia? Is Asia going to be a reportable segment? Yes, because there is a yes somewhere. So in this case here, yes. How about North America? North America, yes. North America, yes. And then we have Central. Central, in this case, ladies and gentlemen, we have no, 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 no. So this is no. This is no. This is no. And then now we have South. South, in this case, ladies and gentlemen. South, in this case, ladies and gentlemen. In this case, it gives me what here? Somebody, no, 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 no. No, like that. So then how many reportable segments do we have? How many reportable segments do we have? We only have 3 reportable segments. So in conclusion, we have 3 reportable segments. We have 3 reportable segments. So we have 3. We have 3 reportable segments. Namely, ladies and gentlemen, namely, we have Europe. Europe is reportable. And then we have, ladies and gentlemen, here, we have Asia. Asia is reportable. Asia is reportable. And then lastly, we have the North. North is reportable as well. We have the North, which is reportable. So that is a 10% rule. After you finish 10% rule, it doesn't stop there. We'll be able to engage a higher level gear. We go to the concept of what year? 75%. equal or above. It's equal or above, equal or above, equal or above, equal or above. Great. So then we do the last test there. The last test, ladies and gentlemen, is a test of what here? Is a test of this 75% of external revenues. 75% of external revenues. So in this case, you mentioned there, 75% test. 75% test. So you come and give us now the 75% test. 75% test. So this 75% test is for what here, somebody? 75% test. 75% test is always for external. Is always for external revenue. For external revenue. So is there somebody who is able to give me the total external revenue? Somebody give me the total external revenue. You guys have the question. Total external revenue. Can somebody give me the total external revenue? Can somebody give me the total external revenue? These guys are not talking to me. I'm not feeling them. These guys are not talking to me. These guys are not talking to me. These guys are not talking to me. So the external revenue, what do we have, ladies and gentlemen, here? External revenue. So external revenue is here. It is 612. 612. 612. So, ladies and gentlemen, if that is the case, could you kindly then give me 75% of 612? Give me 75% of 612. Give me 75% of 612. Is there somebody who is able to give me this very first? 75% of 612. 612. 612. So 75%. 75% of 612. What figure do we have there? Somebody very fast. Oh, yeah, I cannot feel. Ah, yes, it's 459. It is 459. So then these particular three segments, they can only be reportable if their external sale is more than, this 459. If the external sale is more than this 459. So then, ladies and gentlemen, when you come here, look at Europe. Look at Europe. If I just share the question first, if I share the question here, if you look at Europe, ladies and gentlemen, the external sale of Europe ni ngapi? External revenue ya Europe ni 140. External sale ya Europe ni 140. Thank you. Ya Asia ni ngapi? External ni 150. External ni 150. In this case here, North America 195. So could you kindly give me the total here, please, for the three? Give me the total for the three. Give me the total for the three. Give me the total for the three. Total for the three. What do we have there? Total for the three. When you add the three, which from the 10% rule, you're able to conclude that they are reportable. But now there is the sufficiency condition. We normally call this one here the sufficiency condition. So in this case here, this is 400 and what here? 485. So this means that these segments are very serious segments, because you can see this 485 outweighs this. And therefore, in this case, ladies and gentlemen, these three segments, now they meet the criteria of reporting them independently as individual segments here, because they are meeting the two rules. I cannot, in this case here, aggregate them. Now, ladies and gentlemen, point of correction, it's always good to correct these things as we move along. The student here is right. I've just checked there very fast. It's always more than that 10%, not greater or equal to. It's more than. It becomes a segmental report if in this case here you get those 10% more than. Even this 25% is more than. So then up to there, are we together? Are we together? How I wish this guy is here would confirm if you're together so that I can move forward. Great. Now, ladies and gentlemen, I will not do any other question on segmental reports, but I would want in this case here to have a situation like now. We have done this question very well here. You have done this question very well. Nice question, really. Nice question, especially on this results thing. Nice question here. Where in this case, we chose the higher to work with the higher. Nice question here. Now, I would want to take this opportunity to invite all of you to my YouTube channel. There is a question on segmental reporting that I've done there that I would want you to go and watch. My YouTube channel, of course, you guys must be using it. I'm so sure. It's Joshua Aura, isn't it? Joshua Aura, you can type Joshua Aura, segmental reporting, segment reporting. You'll be able to get me there right away. So then that marks the end of this chapter, revision of this chapter. So what are we going home with? I know the definition, right? As a component that can be distinguished, a component that is able to generate its own revenues, and of course has got its own costs. And then the decision-making organ, like the board, is normally interested in the KPIs, is normally interested in analyzing this kind of, if the board is not interested in analyzing its individual performance independently, then automatically that's not a segment. The board must be interested. And then we have this 10% rule. For us to be able to justify 10% rule, that's the first condition, what we can call the primary condition or first order condition. And then we have the second order condition of 75% of external revenues. 75% of external revenues, that means what here? The sufficiency condition. So then can you allow me to go to something different? Hey, you, my students? Thank you very much. At least there is 10%, 75% rule. Now, ladies and gentlemen, as I go to something different, is there somebody who has ever seen this being tested in your past papers? Anybody who has ever seen this kind of a question in their past papers where they are told here to identify? Yeah. And in that sitting, trust you me, in that sitting, I'll be able to take you through very fast this concept of related parties that most guys are thinking it's a useless topic, but me, I know it's a very important topic for you guys. Very important topic. Related parties. Related parties, yes. So related parties, you are required here to know how to define who a related party is, and why should we disclose related parties, and the disclosure of related parties. Those three things. What should we disclose? So when we talk of a related party, what I'm supposed to know, ladies and gentlemen, this is basically a party that can influence decisions in our company. If in this case here, for example, we have RCM, if we have in this case here RCM here, assuming that I'm the owner of RCM, of course I'm not, I'm just a small shareholder here. Real shareholders don't show themselves outside here. They simply invest and then they go away. So then we have, for example, RCM. So RCM, of course, as an online college, ours is a group structure. We have in this case here, RCM Publishers is the parent company. RCM Publishers is the parent company. Owning RCM Online College 100% and other businesses. So this is the parent of our businesses there. So automatically, this being our parent company, they can easily, or rather they are controlling all operations here. These are the guys who will be able to say, directors here, for example, of RCM Online College will be who in whichever year. All right. So a parent company automatically is a related party. Any of our subsidiaries, ladies and gentlemen, will be a related party. If, for example, we are under joint control, assuming RCM Publishers has, in this case here, some other businesses here, I can't mention all of them. Assuming in this case here, we have, for example, like RCM Real Estate, which in this case here is also a subsidiary of RCM Publishers. Now that we are under one parent's control, like, for example, my son and my daughter, these guys are related parties. If, for example, we have RCM Publishers having this as what here as a subsidiary, and then RCM Publishers having, in this case here, for example, RCM Real Estate as an associate. So long as we are controlling one company. So automatically, if you are in control of this, we are speaking here. So closely. You know, if you're in control, it means that this and this company, you know, control means the same. It's one economic unit. So if it's one economic unit, then automatically this has a say over this associate. So it means automatically that RCM Online College, which is a subsidiary of this, is a related party to who? Is a related party to this associate here. Listen here. And I would want us to use various examples for us to understand. So we have, ladies and gentlemen, this concept here. All right. So a related party transaction is defined by IAS 24, related party disclosures, as the transfer of resources, services, or obligations between related parties, regardless of whether a price is charged. IAS 24. Ladies and gentlemen, why do we need to define related parties here in any business arrangement? It's because of the concept of faithful representation. Because what happens if, for example, as a RCM Online College here, if we want to go and borrow some loan from some bank, and then the bank tells us, you know what, you guys would want your sales report the last 3 months. So then what I'll do, I'll simply tell the bank, give me like a few months, let me organize myself, and then I'll go and talk to my parent. You know what? I've gone to this particular bank, and this bank wants me to show good revenues. So if that is the case, then the parent will tell you, hey, you know what? Because the parent's responsibility is to shepherd. There is no parent who will ever refuse their kid. Right? Even Mackenzie's mother, the other day, you had Mackenzie's mother saying that Mackenzie is very, very, very what here. Mackenzie has got no issue to do with Shakahola. I mean, that's a good parent. Any parent, regardless, protect. So you parent because of the relationship. Atakuja ambie huyu, yes, let me, in this case here, buy your products at an overstated price. I deposit these amounts, for example, like continuously for 3 months. They show in your bank statement, and then you go. And that is why the bank, when you take these management reports to the bank will always go to that section of related parties, trying to see how the funds moved. So you take to them. Of course, they would want to go to related parties, trying to see whether most of the funds that you're declaring here came from a related party. Now, ladies and gentlemen, come here. Assuming in this case here, we have RCM Online College. So you're saying that RCM Publishers being the parent automatically becomes a related party here. So assuming Joshua Aura owns, or rather is among the managers of here, of this parent company. So we have here Joshua Aura is a manager and perhaps the only owner. So I'm trying to look at what we call the key management personnel. Key management personnel will have an influence over the parent. They also have an influence over what here? These related parties. Key management. And remember, key management will be me, my wife, close relatives here. Because you can imagine, if, for example, my wife, and this is why you will get even some churches collapsing very fast. We have in this case here, the bishop is a husband. And everybody knows that for sure this is the bishop of this company. But not of this church. But now the wife comes and fixes herself in this church. I don't know whether they're given different names. And then, ladies and gentlemen, what will happen? This lady will come and tell the husband, hi, sweetheart, you know what? today is my birthday, and I would want the biggest of the biggest vehicles here. This, we are under control. Automatically, in this case here, we will be forced to, we have an obligation there. So in this case here, automatically, even my wife will be a relative here. A relative here. It's very important. It's very, very important for us to appreciate this concept of key management personnel. We shall be able to influence decisions here, which can lead to what we call window dressing. And remember, especially for key management personnel, you as an auditor, when you get related parties, for the key management personnel, there is nothing like overstatement of the price. Then they would want to get things from these companies for free. For free. Then you ask them, I can see there is a vehicle that is being used by this director here. Is this vehicle being used for business? But I'll be able to give you these practical things after we finish. For now, I would want us to end this class. We promised 40 minutes. We are way beyond 40 minutes, but I want to believe that you guys are getting practical things out of this. So basically, definition of a related party, related party, related party. So there is a relationship there. And whether you like it or not, related parties are going to transact. There'll be transactions. And we're not saying that those transactions are bad. All that we want for faithful representation, all that we want are proper disclosures. A related party is defined as a person or entity that is related to the entity that is preparing its financial statements. A person or entity. When we talk of a person or a close member of that person's family is related to a reporting entity, if that person has you don't even have to cram this really. The most important thing now, things are coming here. We have subsidiaries. Our joint ventures are our related parties. All our associates, ladies and gentlemen, are what here? Our related parties. And then remember, the other one that you should never ever forget, related parties you should never ever forget, is if you have what we call a pension plan. Whenever you have a pension plan like where I work, we have an independent pension plan, which in this case we have been able to give to some asset manager to manage it on our behalf. So it has been found severally, companies like where I work, call this company, for example, ABC. If it has got a pension plan, these guys can work to this pension plan and borrow out of it. And then put, in this case, the pension monies of the employees at risk in future. Like the government does this, it's very bad. So you must always, these people are very bright, especially the bankers, they are very bright. They'll ask you whether you have a pension plan and whether you normally transact. If you normally transact, the bank would want to know. The bank would want to know. There is a threat there. There is a risk there. There is a risk there. There is a risk there. Good question, Douglas. I'll be able to answer you. I'll be able to give you an answer to that in. Now, when we talk of related party, look at this. This is a reporting entity. So reporting entity, the parent is a relative. And if this parent has got key management, the key management of the parent automatically will become related to the reporting entity. Because the reporting entity in this case here will be a subsidiary. If this reporting has got a subsidiary, that automatically becomes our what here? Our relative related party. If it has an associate, the same. If it has a fellow subsidiary within this parent group, automatically this becomes what here? Our relative. Now, ladies and gentlemen, for us to be able to understand this, and here I should be able to give money. Here I should be able to give money. Test your understanding group structures. So we have entity A. Entity A has 60% of B. So meaning that B is a subsidiary. And then it has 70% of C. Then it has 35% of entity D. Who can tell me? This entity D to C is who? Entity D to C. C is the one that has D, 35% of D, 35% of D. So who is D to C? It is an associate. It is an associate, isn't it? And automatically, an associate of our subsidiary, an associate of our subsidiary is our associate. So it means that the relatives of A, related parties of A, all its subsidiaries are related parties. So in this case here, B, C. And even the associate is a relative of who? A relative of A. Now, let me ask you a question. What do you think of B and C? What do you think of B and C? Are they related? Somebody talk to me tonight. I'm almost finishing. I promised 40 minutes, but I'm just a few minutes on top of the 40th minute. And it's because you guys came a bit late. Otherwise, I was so much ready to finish everything in 40 minutes. What do you think? B and C are both subsidiaries of the same entity. So they are related. They are related parties. And because, ladies and gentlemen, you can see we have A, B. You know, A is controlling B. So automatically A and B are the same thing. So automatically B and D are also relatives. Because here we are in control. So you see A is as good as B. A is as good as C. All right. So D. So if you look at the answer here, ladies and gentlemen, if you look at the answer here, you'll be able to understand what I'm talking about. You'll be able to understand what I'm talking about. If you look at the answer here, if you look at the answer here, if you look at the answer here, and the related parties, and the related parties, and the related parties, so you can see and the related parties test your understanding one, 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 like entity A. Entities that are within the same group are related to one another. So that means that B and C are therefore related to A. Because they are within the group, they are subsidiaries. D is an associate of C. So C is a member of A's group. This means that D is a related party of A. Look at entity B. Entity B, we say, ladies and gentlemen, if I just come a little bit here, B and of course C are rated because they are subsidiaries of the same group. B and D are as well rated, even if this is an associate. The thing is, you can see we are controlling C. I mean, A and C are like the same thing because of the control aspect. And automatically then this associate belongs to the two of them. So automatically D is a relative of even this B, all right? Because again, A and B are one and the same because of the joint control, or not joint control, but because of the control. Subsidiary and parent, you can't differentiate them. These are mirror images of one another. So then when I come back, ladies and gentlemen, to this one, you can see here entity B, entities that are within the same group are related to one another. A and C are therefore related to B. D in associate is an associate of C. C is a member of the same group. This means that D is a related party of B. Ladies and gentlemen, I would want to end this session today. I would want to end this session today this way. It will be very important for you to know that our associates in the group are our relatives. Our fellow subsidiaries in the group are our relatives like that. Our parent is our relative. If there is any pension plan, that is our relative. If we have got key personnel and of course their families, those are what here? Those are our relatives. And then now remember, whenever it comes to disclosures, what are you supposed to disclose? If I remember very well, and I have this as a summary, I have this as a summary, great. I have this as a summary, I have this as a summary, I have this as a summary, ladies and gentlemen, I have this as a summary, I have this as a summary, I have this as a summary, a very important summary. I hope they're able to see my screen. I hope they're able to see my screen in terms of disclosures, in terms of disclosures, in terms of disclosures, this chapter summary. The need for disclosures of related parties, that's not important to me. Disclosure of related parties. You must disclose parent-subsidiary relationship. You must disclose all transactions and balances outstanding. Disclose all transactions and balances outstanding. You must, in this case here, disclose key management compensation. Key management compensation. And ladies and gentlemen, if, for example, it's a SACCO, in terms of related parties, SACCO, you must always disclose what we call insider lending here. How much have we lent to these directors? That is so important. And which loans, in this case here, are non-performing amongst those directors, Okay. So unfortunately, this book that I have here, these are those books that you buy online. I've never shared this one. You cannot get it easily. You have to be taking screenshots. You have to be taking screenshots as I use them, as I use this. The ones that I am able to download and send, those ones I normally send them very, very fast. So ladies and gentlemen, I would want to take this opportunity to welcome to welcome you to these low-hanging fruits. You cannot go wrong. It's a concept that I've used severally, these low-hanging fruits here, especially in terms of the theory areas and group consolidation, group cash flows. You will be able to pass very easily. What I'm able to cover in an hour, I'm so sure it will take most of you like even 2 days to understand. I don't know whether there is somebody who has seen that concept here. Is there somebody who has seen that concept here? Am I cheating somebody? Is there somebody who has seen that concept, that what I'm able to cover here? You guys, if you are to be able to, if you are to read these things on your own, trust you me, it will take you much longer, much longer. So like now, topics like EPSs, those are very low-hanging fruits. Topics like deferred tax, these are simple things that I'll be able to cover very, very, very fast. And remember, like AFR, we are doing AFR every day. Every day. That's why I told you, like the 200 shilling you're paying per lesson, you will not be able to do what here to really get value, because you will pay quite a lot. Because like now, this 10 p.m. class, I'll only be doing the theory areas, 10 p.m. just for 30 minutes or 40 minutes maximum, 10 p.m. every day. And you'll be able to bear witness with me. You cannot fail with this low-hanging class. You can't fail, because there are things like now you'll go to a student, like when we look at the answer sheets they give us, like something like management commentaries and disclosures. Very few students in this case here will be able to give us answers which make sense. Ask a student what is integrated reporting. Like right now we have sustainability reporting now has become mandatory from 2024. So then we expect sustainability reporting to be a great theoretical area this time around. They have produced, in this case here, 2 standards. So as a good student, I should be able to at least get a high-level summary of what sustainability reporting standards are talking about. There is no way, ladies and gentlemen, you can go to an AFRA exam if you don't know, for example, what we call ESG framework. How do we report in terms of environmental, social, governance issues? All right. So you'll go and get a student being asked a simple question that we have in this case here, a director who was in this case here, or rather finance director, yes, a finance director who has not disclosed what we call related party transactions. This guy has not disclosed related party transactions. And then you are told in this case to discuss the ethical guidance on this. So the ethical guidance on this, ladies and gentlemen, of course, I'll be able to remember very fast ethical guidance. We are looking at those things, objectivity. We are looking at integrity. We are looking at competence. We're looking at competence. And of course, in this case, when they talk of ethical guidance, like now, this guy who has not reported related party transactions, he's not objective. Whatever financial statements he'll give us, ladies and gentlemen, in this case here will not really be objective. They'll not be truthful. They'll not be representing the true position of the company here. There must be something that is hiding here, all right? There must be some opaqueness. So it means in terms of integrity, this guy is a liar. He's not a straightforward man. And if he's a straightforward man, then in terms of competence and the due care, I mean, you know, competence means what here? Technical skills. He may not be having the right technical. So he is unethically occupying that position. So you see, like any question on ethics, I should be able to earn more than 5 marks. If they give me a question of 5 marks, then I should be able to get all of them by just arguing like this. But now you'll get a student who does not know anything on ethics totally. Then they say that, so you need this guidance. Whether you like it or not, you need this guidance here. Great. So, ladies and gentlemen, remember, what are we selling here? We are selling, like for those who doesn't want this, we are selling a package. Which package are we selling? We are selling, in this case here, for you to attend these low-hanging classes, low-hanging fruit classes. Low-hanging fruits classes. We are selling, ladies and gentlemen, we are selling 4 things. And most of you don't even know these things. Yeah. So we have advanced Excel. Advanced Excel. So you're looking at the pivot tables. We are looking at things like, for example, index and match. We are looking at the VLOOKUP. We are looking at the dashboard. Like me, I'm an expert over doing dashboards. Actually, that's what gave me a job where I work. So if you give me, like, for example, sales of Coca-Cola, right? in various I should be able to make, for example, Mount Kenya dashboard, which in this case here is through Power BI, which is real time, live. As in this case here, sales is going up, I'm able to see my bars. In this case here, I'm able, especially if I capture this in bubble charts, top game, top notch. So advanced Excel. Then in this case here, we have what we call Power BI as an independent entity, independent course. We have in this case here what we call the Power Query. The Power Query. And then I'll be able to teach my students, in this case here, accountants here, how to capture these Excel formulas and whatever when you're moving from one sheet to another using the famous macros VBA. So all these, I'm giving them to you at 2,500. And this will be a 10 days course, a 10-day course, a 10-day course, a 10-day course, which we shall run immediately after you finish your exams. My objective is to squeeze all students in this case here to go here. And the moment, ladies and gentlemen, you pay this 2,500, then automatically you will be able to attend all our low-hanging classes for free. All these classes here up to your exam for free for Advanced FR AAA. We have in this case here leadership and management, etc. moving forward for free. I mean, I leave from where I work, so now I'm a free man. A lot of energy in this case here within me that I would want to use to help you guys revise, very, very easily. So if you don't want this package, then you can be paying for these classes here for at what rate here? 200 per session. 200 per session. Like if it's AFR alone, I'll do more than 10 sessions. AFR alone will be 2,000. So in this case here, our pay bill, please be serious with this. Our pay bill, which I would want to see you guys paying this, is 62,42,839. Account, just mentioned there, Excel. You'll be able to know where to take you. And then you send the message to 0719 525,000. And then we shall be able to add you 0719 525,000. 0719 525,000. So remember here we have pay bill is 62,42,839. Account is Excel. And then once you pay, you send this message to 0719 525,000. Rest of the topics, thank you for asking those questions. Rest of the topics, of course, we have a timetable. We have a timetable that we shall be using, shall be following. Yes, but remember, 30% of your exam, more than 30% will be theory. So I'll be taking 40 minutes every day to capture the theory, and of course, a high level with also some competition things like there. But we've got some 3 days in the week. Like now, tomorrow morning, I have AFM at 4 a.m. 4 a.m. Students have said they don't want 5, they want 4 a.m. like that. So if we stop there, ladies and gentlemen, I think we shall be okay. Some have done Excel already. I've already explained that, Susan. I've explained. If you feel you have done, please go for this. It will be very expensive for you. I have a student who, since we began, this guy has already used like 800 shillings for the 4 papers. It will be very expensive for you. But if you feel that you don't want this, then go for this. Already I've given you an option. Yes, tomorrow we are starting at 4 a.m., please. I'm sending the link right now. Thank you very much. Good night. Be blessed. Bye. Yes, if you pay now, of course, you'll get the link for tomorrow's class. Yes. Great. Irene, I'll be able to give you the video to this. No worries. Yes, Theo, those classes will be after your exams. The Excel class will be after your exams. Great, thanks.